Hey, how's it sound to work less and make more? I am talking about money, and there are ways to do that through commercial real estate investing. And a lot of people don't know just how easy it is to do nowadays. So, this channel, Pivot to Prosperity, will show you how you can do that. It's brought to you by Pivotal Real Estate Investments, where we go find the deals and do the heavy lifting and then bring you the opportunities. So if you want to know when opportunities come available, you need to register at pivotalrealestateinvestments.com. Every Tuesday at 2 for about 22 minutes, we plan to bring you another video. And so like, share, subscribe. Thank you. Hi, Ginny Bolling here with Pivotal Real Estate Investments, and you are on the Pivot to Prosperity YouTube channel. And this is where we interview people that are in the business of syndications and those that are involved with investing in syndications or providing services for syndications. And today I have David McIlwaine that we will be interviewing. And so David, if you would give us some background on you.
Hey, thanks for having me, Ginny. I'm really excited to be talking to you and your listeners. The executive summary on me is that I was a 20-plus year advertising executive. I was the sales guy that ran the central US for a whole bunch of field offices. One day I got fired. It was the response of a merger where I had hit my budgets for 9 consecutive quarters. I hit my budget for the upcoming quarter the day I got fired. And it wasn't a thing about my responsibilities or my performance or anything having to do with my roles. It was about a merger out of my control. I had lived on an airplane. I was in my favorite seat was seat 1D, aisle, right-hand side, first row, or depending on the airplane, 13D, exit row, right-hand side. I'm left-handed. I wanted my left elbow in the aisle. I don't know, kind of crazy stuff. But I lived on a plane. I went through this metamorphosis, if you will. I went to a job in a tech world as a CRO for a tech company. Fast forward 18 months later, I had done a Series B fundraising. I had helped reverse 7 quarters of negative growth to positive trends. I had actually turned the corner. We had closed on the Series B fundraising. I came in the next day to execute the plan to hire 35 sales force. There were 35 sales reps across the country. My CEO said to me, "Hey, guess what? We paid off all our debt." I'm the CRO. I didn't know we had any debt. The next week, I got laid off again. So twice in 24 months, laid off, regardless of the performance. I looked around. I ended up becoming a single dad through this process as well. And I realized that real estate was the place to be. From there, I opened my own residential brokerage. And from there, I realized that multifamily was scale. In my advertising world, I had sold scale in the past. So when I saw this, I knew in 1 minute what to do. I literally sat down in an event, listened to a speaker, and changed my entire business model in my life. Fast forward a year later, I was a general partner in 1,000 Doors. I had transitioned my entire business to this, and I love it. I don't know, is that a good summary?
Yeah, sure is. 1,000 doors in 1 year. That's phenomenal. That
Yeah, it was a
really
good
is.
start.
And that was GP, LP, both? You just said?
That's just the GP side. LP
GP.
side, I invested some in the LP side, but the reality is that I knew this was my profession. And so
Yeah.
I didn't spend a lot of energy and effort doing the LP side because as an LP, you can't be involved. Since this is my profession and I already had 7 years of real estate experience prior to getting into multifamily, I knew that putting my passive money to work and other people's deals was going to prohibit or preclude me from putting my skin in the game alongside my investors. And one of the most important things you can do is you can have a shared experience and a shared piece of skin in the game. If I'm not invested, why would I think my investor would want to invest? My job is to grow my net worth, and my job is to grow your net worth. If I can't do both parallel, I'm not performing. So I kept my money and used it for GP, LP split.
Totally understand and totally agree with that. Yes, yes. So when you're assembling a team, then David, what do you have a set team that you take to any property, or do you change it up based on the product that you're looking at, or how do you approach that?
Great question. There's 100 different ways to skin this cat. Real estate's a team effort. What I came to learn was that I would put together a co-GP model based on what works for that event at that time. And the beauty of that is that there are a lot of folks like myself who are reformed corporate America executives. We have a ton of skills and we have a ton of knowledge and experience on business and people and personnel. And so I put together a team of co-GPs that have a varied range of experience, from real estate to corporate America to operational disciplines to finance disciplines. And I bring them together at a given project based on the needs at hand.
Right. I totally get that. And I think that timing's everything. If someone's already too entrenched with another project, you got to respect that or projects, they may or may not have all of the bandwidth that you need. And I like to also delve into locale as well, so that there's someone with local knowledge if it's not necessarily a place that I know intimately already. I suspect those are all factors that you look at too. Well, so in your market, where all are you buying?
Currently, I have property in the Kansas City metro. I have property in Georgia, Alabama. I sold an asset to my partners and I left the partnership in Arkansas. And I'm looking aggressively in Colorado. I'm based in Denver and I have lived here for 30 years. I know this market intimately. I'm also continuing growing in Kansas City. I just brought on an acquisitions partner in this morning. Before we started doing this, we were going through a market selection exercise. And I'm going to continue to be in Kansas City. I'm going to continue to be in Colorado. I'm going to continue to be in the Midwest. My buy box is typically the central time zone and the mountain time zone. Now, that's a wide swath. So I think 23 is a year of evolution and change. And that's going to include changing market-specific selections. I foresee going a little further north than I have in the past, because I think there's some honey hole markets that people aren't talking about much. I think that Texas has some real problems in some places with insurance costs. The hurricanes have really affected insurance costs. There's no doubt about it. And I just what's the most recent hurricane?
Ian.
I knew it was an I. Hurricane Ian. What was the total loss? I think it was $5 billion. Is that what it was?
I don't think they're done counting.
They're not done yet, right? Hurricane Harvey was a decade ago.
Right.
In Houston, Hurricane Harvey had 50,000 cars destroyed. Do you know what happened to the car market in Harvey directly post, or in Houston directly post Harvey? The car market skyrocketed. And then what happened in Denver was that the used car market got flooded with flood cars. Literally flooded with flood cars, right?
Right.
And so Ian is going to have similar impact across other marketplaces. Drywall costs in Texas skyrocketed. You're going to see the same kind of challenges again. And we're already seeing that. So I'm not as bullish on parts of Texas as I am other parts of the country. One of the reasons I'm a little hesitant on Florida is the same. You've also got the condo collapse that occurred on the coast, and that's changing the building regs in Florida. It's going to change some other regs in Florida. It's going to require different analyses. Yeah. So I'm looking more heartland.
Gotcha.
Give a long answer to a short question.
That's a compelling argument too. And me being here in Orlando, one of the other interviews I did this week was with a gal that writes insurance. And
what was her take?
Similar. I mean, it's very hard, but she has excess lines is what it's called, that she goes to, the Lloyd's of London types. But you don't like the price, it's not going to always be a price you can really, you end up counterbalancing with being self-insured.
Well, when you're buying insurance, you're selling risk. You're off putting your risk to somebody else's books.
Yeah.
There's a cost to that.
Yeah.
And people forget about it like that. They think that a lot of people think of insurance not as a risk transfer or a mitigation of risk, but more as a must-have because the bank requires it. But if you think about insurance as a distribution of risk to someone else, and you're paying them to take on that risk, that changes the model.
Yeah. Yeah. No, I totally agree. I'm all about containing risk, and that's a smart way to look at it for sure. So let me back up a little bit too. You said that a lot of what changed your life was also that you have kids. How old are they now? Is it one or more, or what?
I have 2 kids by my first marriage and 2 stepchildren. I just got married last summer. And so I have 4 kids now. The step kids really aren't kids because I got married last year. And as you'll see, one's graduating from the University of Iowa. One attends Metro State here in Denver. So it's 21, 20, 19, and 18. My kids are at Rutgers as a sophomore, and I've got a freshie at the University of St. Andrews in St. Andrews, Scotland. So I've got people all across the US. I got kids in 4 different time zones.
Yes, yes, that gets interesting when you all get together, I'm sure too.
It does.
Yeah, that's terrific. And so then are any of them getting into real estate or interested
Well,
in what you're doing?
last night's lottery drawing was for $1.3 billion. And the payout was 600 million roughly after taxes if you take a lump sum. And I explained to my 2 children that they were going to have to go get master's degrees in real estate because I was going to go build a private equity fund with a $300 million capital and go take that into 1.2 billion. And so right now, no one's in it. They're still studying stuff. One's going to be a vet, one's a poli-sci person, one's a history buff, and the other one's undeclared. So who knows?
Yeah, you don't know. Right.
Yeah.
I think that the most frequent comment I hear from my kids is I'm at my computer too much. They don't want to do what I do. But yeah, there's a lot to it though. As you know, you have to go look at property. You have to go meet people. Tell us a little about what your process is.
Well, my process is really disciplined on stats and facts. In the advertising business, we sold things based on demographics, and it's the same thing in real estate. So my process first and foremost is to determine a marketplace and then determine submarkets within that where I have positive trends, i.e. employment or unemployment, depending on how you look at it, rent growth, migration growth or stagnation, asset valuations, i.e. cap rates. Once I flush that out, I'm going to build relationships with brokers and sellers directly. As a broker myself and having been a sales executive for 20 plus years, I really understand how to dialogue and work with the broker community to bring out their skill set and my skill set. I know what to trust in them. And believe it or not, brokers are really trustworthy in certain areas. They really are. They're a partner. If you treat them right, they're partners. If you treat them like they're vendors or subservient, they're going to give you vendor and subservient results. So I work very hard on that. Then we analyze. We have a set scorecard. If it meets our scorecard, we'll go to the next stage. That stage is obviously going to be LOI, getting to a letter of intent, starting to negotiate purchase price, working through that stage. If we pass that stage and we get selected as the buyer or we are the compelling offer, we'll then go through a due diligence window. That due diligence, we've got a set of scorecards as well. We're going to go look at all the due diligence in my mind is very important. And I've got a due diligence website for listeners that want to say it out. If you go to my website, you can download some key piece of information on how Mac Assets does due diligence. I've got a 3-page spreadsheet that we go through. And what we look for is that there are 3 things happening when you're buying a multifamily or any commercial asset. One, you're buying a piece of real property. That's what people think about. Then 2, you're buying an operational business. Because when you're buying a piece of commercial real estate, whether it's multifamily or triple net industrial lease, or it is an office building, there's an ongoing operational business concern. So I do a due diligence structure on the ongoing business the real property. And then third, we do due diligence on the anticipatory or the pro forma response of the business plan we're going to implement for both of those entities. A lot of folks talk about due diligence in terms of the box. Does the box have a good heater? Is the heater good? Yeah, that's part of it. But when you buy Class B and Class C assets, which means basically you're buying assets that are 20 years or more older, there's more to it than just the box. You're going to have problems. Due diligence is not around figuring out what's wrong. It's around learning what the problems are you're going to run into. For example, if you have stab lock or Western Pacific, I just totally lost it, junction boxes, fuse boxes,
right,
that were built in the 70s, and you're going to have to implement a plan for that. If you have aluminum wiring, you have to implement a plan for that. If you have termites, you got to implement a plan for this. And due diligence is where you learn what you do have. Now, when I go through a tour prior to LOI, I look at all those things. Most of us do. There's nothing surprising in that. And you try to figure out what the problems are before you go through that, and then you build a plan. But due diligence is really about making sure the business plan you've built under the first or second tour is viable.
Right. Yes.
Every due diligence trip you're going to be on, you're going to find problems.
So what's been one of your biggest surprises that even during the due diligence that would be atypical? I mean, have you ever, for instance, come across an extreme termite situation?
Well, here's an interesting one. It wasn't what you would normally think. I flew in for a due diligence acquisition the night before the program started. I landed during daylight, so the first thing I do is drive to the property because it's close to nightfall and I want to see the property at night. I saw 3 kids that were toddlers playing in dumpsters.
Wow.
Yeah, horrific as a parent. As a landlord, it's even worse,
right?
Because the liability is extreme.
Yeah.
So I just learned more about my tenant base in 30 seconds than I would at any point in time. While going through that property, I ran into people that were making a living on the internet, exposing themselves. I saw people that were using knives to hold windows functional in their car. So they use a knife as a lever to keep their window from falling down.
Wow.
I saw bullet holes in breezeways. So I knew to modify my business plan to include crime abatement. That hadn't been in any of the stuff before. Did that scare me away? No, it actually performed pretty well. But did I understand what I was going into? Yes. So every property you have to go in, and I shouldn't say you, every property I go in and I look at what are the things that I know behind the scenes. So when I saw those toddlers playing, I knew I had to have a very detailed insurance script that covered things that I might not pay attention to in a Class A.
Right, right.
I then drove past the probation office that was about half a mile away. So I knew there was going to be a crime concern, and so I dug into the crime stats more. So when you look through the territory and you look at the windows, you understand what you're buying.
And that did
deal
actually
turn out to be great, by the way. And I don't want to say anything else about it because it's really not okay to talk out of school, but you get the idea that you learn something about it.
Right. Terrific. And that touches on something that's very important too, you know, that my former life as an appraiser, there's only so much you can do with the location and external factors. And I love the idea of having a crime abatement line item. I think that there's a lot to be said for that. And
right, a crime abatement line item. I hadn't labeled it like that. I just said security cost. But there's security costs. Then there's going to be an improvement in lifestyle. So how do you get the tenants to have pride of ownership, or I like to refer to it as pride of occupancy?
Right.
If you have pride of occupancy, what happens to your residents' lives?
Yeah, make it better.
They
Right.
get better. And ultimately, my job is to help my residents' lives get better. When I help my residents' lives get better, my investors increase their net worth. There's a very direct line.
Totally agree. Right. I think that's great. And that's where we align. I'm very community based too. I love, looking at your website and whatnot that you have that stated through
Thank you.
many different ways. Right.
And it's true.
Yeah. And I also have to say, I love your name, Mac Assets. Does that mean you get Mac deals and Mac returns? And
Well, the name like McIlwaine. So it's really, I did it as an acronym: multifamily, adventure, and commercial, or multifamily, active, and capital. But what I really wanted to do was say it's an asset. We're doing assets. Capital infers it's just about the money. An asset is about more than the cap, more than the money. And my approach for people that are high-level sales executives who want to have a way to protect themselves from the inevitable downturns of the career is to have shares of assets. It also is forward thinking, because my next role is to build a vertical asset management structure and a vertical property management structure. Right now, I don't have enough critical mass in the markets I'm in to have a complete team that's self-employed by Mac Assets. So, but that's the goal.
well, mergers and acquisitions can be go both ways.
Yes, correct.
Maybe it's your turn to do the acquiring.
And I'm looking at that, but I'm still, I know I have the model. I know where I'm going, and it's not to that trigger point yet. I've done M&A in the past, and I understand exactly what I'm looking for.
Right. That's terrific. And I was downsized too. I finally found out what that's like. So I totally identify with the experience you had gone through.
Yeah, and the feeling of that is horrific, right?
It is.
And
Yeah.
I remember I could smell the guy's breath that had been my competitor for 15 years that sat across the desk from me when we got bought. And my boss, who had been my friend for a long time, called me and said, "It's over." And the guy across the hall from me, I was so mad at him. And he's like, "Hey, it's great meeting you. Have a good day." But the reality is that what I had to do was reinvent myself.
Yeah.
And as a sales executive, that's what we have to do every time. And you have to be able to change and adapt. I keep saying you, but it's really, I have learned I have to change and adapt. And the worst thing I can do as a sales guy is expect that there's no change coming in my product, in my environment, in my corporation. There's no technological disruption. One of the reasons I got into real estate post the W-2 downsizing was Amazon. I looked through Amazon, and in the advertising world, we were disrupted by technology. When I started, there was no internet. There was no satellite radio. There was, the biggest things were network television. There were 3 networks at the time. Not Fox didn't exist, and newspapers. But as the world changed, Amazon disrupted, tech disrupted, the computer, the cell phone disrupted. And in real estate, specifically multifamily, you always got to live somewhere. So if you're living somewhere, you can't get Amazoned out. Yeah, there's going to be change. Okay, we have electronic door locks. We're going to have electronic payment structures. We're going to have efficiencies of scale. But inherently, Maslow's hierarchy of needs says food, clothing, shelter.
Yep. Right. That's why I like multifamily too. Now, are you venturing into other assets too?
Yeah, this year we'll do some offerings, probably in the self-storage endeavor, possibly triple net industrial leases or retail leases.
Yep.
I think there's some bull opportunity in suburban office spaces and Class B markets, Tier 2 markets. You'll see that with COVID, there is a flight to the suburbs.
Yes.
And small operators are getting tired of working from their home. I think one of the things that we learned during COVID was that people do need connection and community, and they do need to move. And getting up all day, working at home all day, staying at home all day, and going home to home all day is a lot of home.
Yeah. Right.
That's why Starbucks is a third place. It's a very successful third place, right? So I think suburban executive suite office, there's some value in that.
I agree. I agree. And so in your apartment communities, are you incorporating some workspace or anything to give people a place to go right on the property? Mixed use?
Well, that's a great question. I've toured several properties where that was an option because of the footprint of the design. And our current ownership portfolio, that footprint design does not work, because in order to do that, you got to take out a unit. And if you take out a unit and the unit is throwing off, let's say it's $5,000 in free cash flow at a 5 cap, you're losing $100,000 in value by doing that.
And one of them won't do it by itself. Usually you got to do a few.
And my job is to help you, my investor, grow your net worth.
Right. So in my appraisal days, I got into those feasibility cost benefit analysis. It's a real important thing.
It is.
Yeah.
And the cost benefit on this right now in workforce housing and B and C property is that it's not something the B and C resident will pay for. The A resident will.
Yeah.
The A resident demands it. And what we mean by A resident for your listeners is that the
yes.
property that's built in the last 15 years. And it typically attracts the most highly educated residents. And it also attracts it garners the highest rent per foot.
Right.
And so think about the beautiful, most pretty, sexy apartments that are built and the things that are going up in urban cores and major metros. That's what we say.
With the great amenities.
For example, my stepdaughter lives in a Class A new build here in Denver, and she has a 6-story building with concrete parking structure that's 3 stories high. She's got a brand new 2-bedroom, 2-bath ensuite apartment, and she's paying $2,500 to $3,000 a month. They've got a bar on premises. They've got a full suite of workspace, co-shared workspace. They have a dog wash place. They have concierge trash. Everything that you have in a Class A is available. And that's a different tenant base than the guy who is working for, let's say Home Depot or Waste Management or a plumber. And he's a working guy who gets his hands or her hands dirty every day. Different structure.
Right. Right. Yeah, no, it's very true. And you have to know where you're at, because if you've got this dream to do certain type of property and the neighborhood's not going to support it, it's not
you're wasting your client's money and you're doing bad business.
Right. Right. Well, so, and now you have, how many properties have you gone full cycle on?
I'm getting ready to exit my first property full cycle, and I think I'm going to exit 3 this year.
That would be amazing.
Not completely flushed out yet. Obviously, it's the first month of the first quarter, so there's more knowledge more learnings will be revealed. And from a full cycle point of view, we got some that are under contract, and once they close, then we have clarity around how that looks. And selling a property in today's environment is a challenge.
Yes. Yeah, it is. And so are you thinking to 1031 some of your investors into another deal, or how are you looking at that right now? Do you have any?
Great question. Let's talk tax strategy for a second. Another reason you buy multifamily is for tax strategies and for deferred losses. When you invest with MAC assets as an investor, we're going to do a cost segregation study. Cost segregation basically puts property into 3 buckets. A 5-year, a 10-year, a 15-year, it's 4 buckets, and then a 27.5-year depreciation cycle. We have the ability to then accelerate everything in the 5, 10, and 15-year bucket in year 1 of operation to 100% depreciation. What this means is that if you're investing $100,000 through 2022, the odds of you getting a $80,000 tax deduction are really high. And so somewhere between 50 and 80% tax deductions on every dollar invested through cost segregation was the norm. In 2023, the bonus depreciation laws have changed a little bit, and there's a grandfather clause. So instead of having 100% depreciation year one, you have 80% year one, 20% year two. I am not a tax accountant. I am not a CPA. I am not giving tax advice. I've told the SEC and you. But what I will say is that when you buy that real property, you also buy a business. And when you're running a business, you have the ability as a passive investor to realize the passive losses. Then those passive losses can be put on your tax return and carried forward such that in essence, you get to almost a neutral tax structure over the course of the hold. Yes, there is some recapture when you liquidate. And yeah, there's some balancing in this. But the math, talking with your CPA and your individual tax picture, basically says that when you do this as a passive investor, the gains are almost tax-free. So why would I tie up 1031 money if my investor can pay, let's say it's a 10% tax? After all that math, when you put together a 1031, I'm not peeing on the 1031 parade. When you put in a 1031, you have to do it as a tenant in common. And if you're going to do a TIC, as they call them, then you have to have other requirements. And most syndicators like myself don't want to talk with you unless you've got $1 million in that TIC, because it costs a whole lot of legal compliance and a whole lot more. I've got TICs in my deals with other members, and it's not a prohibitive thing, but what's the cost benefit analysis for the investor? If you're talking about a passive investment of $100,000 and you make $100,000 and you're going to take home $90,000 post-tax, is it worth that money to save $5,000 in taxes? It's really not. Yeah. Now, when you get to the millions and you're going to save $150,000 in taxes, it is. Right. So generally speaking, my investors are not at that multi-million-dollar lever point today. But that doesn't mean I'm not having those conversations. Right. In fact, I am having those conversations, and we are growing your net worth. If we're growing your net worth, we're not going to give you financial advice, but I'm going to lay out the facts from the property that we're representing. And I will make sure that there's another offering for these individuals to redo their capital with.
Right. Right. There's some avid fans of 1031s for sure.
There are.
Yeah, it makes it a little challenging though in the syndication structure, like you say, for the smaller deal. It's just not. It doesn't make it worthwhile, really.
Yeah, I was in a conference in New York City with some guys on Wall Street, and one of the guys had done $150 million in 1031s. Totally different ballgame than the guy doing a $250,000 1031. And if you're doing a 1031, there's got to be enough skin in the game to make it worth balancing out the fees for the legal, for the title, for the ongoing business structure. Then you've got to consider, do you want that money controlled? One of the things that 1031 does is it forces you to re-express that capital under a very specific gun. You have at most 180 days to decide where and how you're going to deploy, and then deploy that capital, or you get taxed anyway. So you've got to make sure that you have a very strong series of dominoes to fall to make a 1031 worthwhile. Or you've got to control it. As a passive investor, until you have a $500,000 or $1 million at play, it's probably not worth your time. Now, it's not my money, but this is just what the cost benefit analysis that I've done is. My investor can have their own opinion, and I'll facilitate whatever they need.
Now, and you've said your primary client is the high net worth sales folks out there that are in all different industries, I gather.
Right.
So what is your typical contribution from them? What is the typical?
It's a six-figure commitment.
Yeah, nice.
And when you think about it, as a high functioning sales professional, either in management or out of management, you can make a bonus of $300,000, $200,000. And you can make your commissions, if you take the discipline to take that bonus of $150K and you pay your taxes on it, and then you invest it for 10 years, just that one commission. 10 years later, you're going to be around $1 million. Then you get FU money. And what do I mean by that? That means that you can tell your boss when they go in and they change your quota and it's unrealistic, pound sand, I'm done. Or you have enough passive income at that point to where if you lose your job or when you lose your job because of a merger, an acquisition, an economic downturn, you've got a cash flow stream. So you don't have to take the job that's crap that you don't want to take. Look at what's happened. This week alone, you had Amazon announce layoffs. Netflix has announced them. Facebook announced them last quarter. I'm kind of running. I think I've counted like 30,000 layoffs in the last 30 days. And I need to put that list on my wall. And those guys are operational people, salespeople. Salespeople are paid to make it rain. And there's a tremendous amount of skill involved as a salesperson. But what salespeople don't pay attention to, that I'm here to help them in, is how to grow your net worth. If you're just making your commissions and you're buying and you're buying, and you're consuming, that train runs out when you lose your gig.
Right.
But what I can do is I can take that one commission payment, that one big sale, and build financial stability for you and your family for the rest of your career. That's
terrific. Right.
Powerful thing.
It is. It is. And now we're running out of time here. So why don't we go ahead and have you tell how people can get in touch with you? macassets.com, right?
macassets.com.
Okay.
Yes, macassets.com. Did I say macassets.com?
All right.
And I've got on there an opportunity for you to educate yourself. There's a couple podcasts I've been on as well. I've got 2 different ebooks I've published. One is How Ugly Apartments Deliver Beautiful Returns. And that's what we've been talking about today. And then the other one I mentioned is the due diligence checklist to see how due diligence is done. That's not just property specific, but business focused.
Yeah. I like the way you look at that and describe that. That's good. That's really good.
Thank you.
Okay. The one last thing I told you I was going to ask you, how do you spend most of your day? What do you end up doing most of the time?
I spend my day problem solving. And my job is to help my investors build their net worth. And one of the mechanisms to do that is to solve problems. So I have several properties and I'm asset managers on a bunch of things. And so I will help the property management team problem solve. I will work with my acquisitions guy on how do we hit our metrics and what are the challenges we have with underwriting, helping to problem solve. Just like being a sales coach is teaching your sales force how to maximize client relationships. My job is to maximize and problem solve. So I spend my day problem solving, whether it's on site or whether it's behind the computer screen. And then I spend some of my day evangelizing what we do here. So that's kind of it. I love it. It's a great career. It involves all parts of the brain and I get to help people. There's nothing better.
That is one of the things about this line of work. Commercial real estate is challenging. You get to use all your brain, it seems like, or at least a lot more than anything else. Yes. Terrific. Well, thank you so much. I appreciate you coming on.
Well, thank you, Jenny. It's been a pleasure.
Well, I hope you enjoyed that. If you did, please like, share, and most importantly, if you want to know when an opportunity comes available, do register on pivotalrealestateinvestments.com so we can get in touch with you. It's important to have a conversation. Likewise, follow us on Facebook and Instagram. We'll have free things we pass out time to time. Thank you.